So look, why not bonds? Bonds are essentially, as I said before, they're the risk-free rate. Very low risk, but very low return. The rate hovers close to inflation. Over time, this means you make very limited real profit. So what real profit is really is, it's essentially how much money or how much return you've got over inflation. So you're barely going to make anything with bonds. And I hate to say it, it only makes sense for someone who's on a retirement plan and is completely risk-free and has a lot of, maybe even, I probably wouldn't even buy it if I was them. So no, I take that back. It doesn't make sense at all. Don't buy bonds. What about stocks? So look, I'd say the ASX has returned close to 5% over the past 30 years. Like I said, it's done about, 7 to 8 fold over 30 or so years since its inception. Stocks can have solid yields with solid returns, but the issue is they're difficult to borrow and leverage against. So that means you have to use all of your own money. It's risky and stocks can actually delist. So a stock can go to zero. Companies can close down, for example, right? And in saying in stocks, I wouldn't invest in the ASX if I was in stocks, I'd invest in the New York Stock Exchange or the NASDAQ, because that's done like 9% over like 100 years or something like that. So you're getting a better return and you're buying essentially the same thing of stocks. So what I'd say about stocks is they're a high risk, moderate return asset in essence. Businesses. I like businesses, but it's definitely not for everyone. I'd say it'd be less than probably 3% or maybe even 2% of the entire population should invest in this because it's very risky. Look, the issues as well are it requires a significant amount of capital investment up front with limited long-term statistical guarantee of return. So you usually need for even a business loan minimum, 30% plus closing costs. So it's probably 40% of the asset value. And you don't know if it's going to return. Like businesses can shut down completely. The thing with businesses though is borrowing is actually quite easy if the numbers work. If you find something that has very good cash flow, you can often borrow against it if you have the deposit very easily. And second to that, because of that, you can leverage against it quite easily as well. But the risk comes with that is that businesses can delist, hence being that you take the entire risk. So if you have a business and it delists, they can come after your personal assets too to actually liquidate you. So that's the other thing. Well, if you're set up in a trust or trading company, that's probably a little bit different. But if you're taking it on in your personal name, which I don't recommend doing, you are taking on a lot of risk. But in essence, businesses are very high risk, but very high return as well. But again, you've got to be in that very top echelon kind of people that know how to run a business. And secondly, not only run a business, but also understand finances. That's the biggest thing, because there's a lot of people who can run a business very well. There's a lot of tradies that I know that make quite good money, but they don't actually net much money because they don't understand finance. So that's a good example of businesses. Look, my favorite thing to invest in Australia, and as everyone knows, this is a real estate investing channel, is real estate. And the reason being is it's Australia's best performing asset class because of the cash flow and capital growth. If you know where to buy, you can get above 13% long-term return, which is insane, right? That's basically like getting a fund, one of the better fund managers on Wall Street, basically using your assets. So that's one thing. Look, another point there is it underpins basically our whole wealth and our whole economy. And that's homes, super funds, investments and shares. So it's about 75%. That number's only increasing as property prices go up. Australians are obsessed with property, right? Look, not only that too, but it's very easy to borrow for and it's very easy to leverage against. And I like to use the example of stock market investing compared to real estate investing. I like the example of a good stock investor, and a very good one, let's say, might be able to average 10%, and that's better than the average of the NYSE. So if you're stock investing, you can do that. You are actually very good. But let's say you average 10%, right? And let's say you got 100 grand to spend and play with, right? If you go to the bank and try to get a margin loan, you'll struggle to even get 30,000. But let's say for some reason the bank gives you 50. So you got 150 grand, right? And you're good in the first, and you do 10% return in your first year. The issue is stock market prices are their prices what the market pays them. That's the only thing you get it valued for. So that's the other issue you've got. But let's hypothetically say you got 100 grand as well, and you go to buy property. and let's say you buy one that's $500,000, and let's say even if you buy shit, which I don't recommend, but let's say even if you buy something that does 5% and you got 5% after your first year, 5% of 500 grand is $25,000. So you could be half as good and you still earn literally nearly double a stock market investor just from buying real estate because you can leverage against it. But secondly, on top of that, is that real estate's a game where not everyone knows how to value it. And you might buy something where a lender might, let's say for 500,000, in a year's time, a lender might say, even if the suburb median is still 500,000, the lender might say it's actually worth 550 because you've purchased it under market. So that's the other thing. Then also it's very easy to leverage against. So like, you can leverage, 90% of a property value quite easily, and you can pull out equity quite easily as well. So it's great for that. Final points I want to make is just it's tangible. So look, land is always going to be there. If a property blows over or a hurricane comes by and your property's gone, your land's still worth something. If for example, business or stock, it delists or is in liquidation, there's nothing there. It's worth absolutely nothing. Whereas real estate, you can still sell your land. It's still worth something always. It's tangible. Finally, if you know where to purchase and what to purchase, it is low risk and high return. So, the risk return equation, a lot of people always want high return, but I'd always argue that if you can lower the risk and still get similar return, I'd do that over something with high risk, high return, and that is real estate. So by country mile, it is the best thing to buy in Australia.